Step number one, we have to understand why this matters. So let's go straight to the charts. The first one I have is the United States federal government deficit going back to 1950. So from 1950 all the way to 2020. And to be very clear, this is the amount of money the federal government spends in excess of the tax receipts it collects. And on the vertical column, it goes from 1% all the way up to 10%. So back in 1950, the federal government budget deficit right around 1%. It goes down to where they actually had a surplus. Imagine that. Goes up a surplus again. Then it keeps kind of bouncing back and forth. Goes way up in the recession after 1980. Then we go down the dot-com bubble. We had a lot of tax revenue coming in, so we had a surplus then as well. But since 2000, it's done nothing but go straight up. And you see in the last GFC, it went north of 10%. That's really just a mind-boggling number. We go back down, but not that much. It bottoms out around 4%, which would have been recession levels prior to 2000. And what I think is kind of funny about this chart, editor, go ahead and throw it up, is it was back in 2019, they're sounding the alarm. Deficits have only been at these levels in or after a recession. I know Jeff Gundlach was saying this as well. But look at what has happened since we've had the cerveza sickness. First and foremost, deficits were bad to begin with. And this is just like the economy not having enough savings. You can get away with it for a little while, but when we have a recession, a rainy day, and especially we get a depression, that's when you've got really big problems. We can see that on the chart when the cerveza sickness hits. Projections now are for the deficit to be $4 trillion. And you know as well as I do, if they're projecting a $4 trillion deficit, it'll be a lot higher than that. But let's just say it's around $4 trillion. That takes us to infinity and beyond big time. In fact, it goes off the chart. I can't even get the dot below the title of the video. If we need to sound the alarm at 4.5% and above, if that's the no bueno zone, where are we now in 2020 when the deficits will most likely be at least 18%? And of course, you can't have a conversation about the deficit without talking about the debt to GDP. That's our next chart. Start at 1910 all the way to 2020. On the left, it goes from 0% up to 110%. In 1900 to 1910, look at that, 10%. Boy, wouldn't that be nice? And we have World War I. It spikes up, goes down in the 20s, and then really goes up in the 30s. When we get to World War II, it goes parabolic, up to 120%. A lot of Keynesians look at this to justify our current levels of debt, but what they don't tell you is these were non-recurring costs. We're not in a war continuously. All the costs that the government has now, or the majority of the cost, are recurring, meaning we can't get rid of them. We're stuck with them. It's just like the difference a business has between marketing spending and their rent or payroll. But moving on, as you can see, from World War II, it gradually goes all the way down. We get rid of that massive burden of debt, and it hits a bottom right around 1980-81. Since then, with the exception of the late 1990s, we've gone straight up. And remember, this chart stopped right around 2019. So if our deficit is going to 18%, if not higher, where is the debt to GDP going to be? The problem, it's just like the example we used with the deficit and not having a rainy day fund. Yes, the economy can muddle along at 100% debt to GDP. It's not ideal, but you can manage it. When you start with the debt levels that high and you do have a recession or a depression, you go from an economy that can just get by kicking the can further down the road to a complete debt crisis. And after the cerveza sickness, who knows where the debt to GDP will be? Obviously north of 120%. Will we get up to 150%? 200? Will we exceed Japan? Who knows? Only time will tell. But what this means for you is your taxes are most likely going much, much higher. As an example, California has been in the news recently for being the first state that is going to have to borrow money from the federal government just to make their unemployment payments. And I also want to remind everyone that during a depression, especially a deflationary depression, where the government can't inflate away the debt problem, taxes always go up, not only on the rich, but the poor and middle class as well. Editor, throw up a chart of the Depression in the 1930s. We can see that even the lowest income group had their taxes raised. And also, let's remember all the videos I've done on the changes to the tax code in 2018, where they stopped using the CPIU and went to the CPIU. And for those of you who didn't see those videos, I'll put a link in the description below. They are a must-see. Basically, what the government did is they went to a different system of measuring inflation, which keeps tax brackets artificially low. If tax brackets stay too low, if they don't keep up with inflation, that means the government takes a bigger and bigger portion of your paycheck. And of course, the low-lying fruit for politicians, always property taxes. Let's go to an article from Chicago that outlines this beautifully. This is coming from the mayor of Chicago. We're looking at a range of potential revenue-generating options. Look, the reality is, I don't think there's any city budget across the country that is not going to have to take a look at one-time measures. Yeah, one-time measures, sure, to put yourself back on track, meaning she thinks every single city in the entire United States is going to have to jack taxes. She said increasing property taxes is always the last choice, but get this, even though it's the most reliable source of revenue. And when we look at the deflationist versus inflationist argument, one thing is always left out of the discussion. They never talk about taxes. If you're someone that believes the United States is going into proper deflation, where all prices are going down, that means the government cannot create inflation. How is the government going to service their debt, not only at a national level, but also at a local level? The answer, of course, is to increase taxes. For the inflationists, what they tend to forget is they think all prices are going up, including asset prices like the stock market or their homes. Let's say you have a home right now that's worth $100,000 and it doubles in price. It goes up to $200,000, but it only goes up with the rate of inflation. If you sell your home, you're going to be taxed on the $100,000 gain. But keep in mind, you didn't increase your purchasing power. So the government is taxing you for no reason. You can't buy any more goods and services, but you have to pay more tax. The bottom line is, regardless of whether you're rich, middle class, or poor, your taxes in the future are definitely going up, whether directly through just an increase of your tax rate or indirectly through inflation. Step number 2, the Kiyosaki method. In other words, using real estate depreciation to your advantage. So my good buddy Robert Kiyosaki is right here, and he just wrote a brand new book, or maybe one in the late 90s. Regardless, it's the book that made him famous, Rich Dad, Poor Dad. So all these people come in and they see it at the grocery store, they get it on Amazon, and they say, Robert, we want your book. So all this cash goes from the people to Robert. He sells them his book, Rich Dad, Poor Dad. So what does Robert do with the money, the cash he gets from selling his books? Well, he goes straight to the bank and says, listen, I need to get a loan because I want to buy an apartment building. So Robert takes some of his money and a lot of the bank's money and buys an apartment complex. Then he takes the cash flow from the apartment complex, and what he told me is he likes to buy a lot of gold and silver with the cash flow. So how does this keep him from paying taxes? Well, let's say the original amount he got from the people buying Rich Dad, Poor Dad was $1 million. He goes to the bank, borrows another $4 million to buy the apartment complex for a total of $5 million. And let's say the cash flow from the apartment building is $150,000 a year. So a 15% return on his investment, his out-of-pocket cost. Not too bad. But the depreciation from the $5 million property is $166,000 a year. So he's paying negative taxes. He gets an additional tax benefit that he can use to offset other income. And that gets a little sticky as to whether or not he's a real estate professional. But this is the way it works conceptually. So how does this beautiful thing called depreciation actually work? We take the value of the asset or the cost basis, and then you have a depreciation schedule. That's what the IRS calls it. Typically on residential, it's 27.5 years, but just to keep things simple, I used 30 years. So we take $5 million. That's how much Robert bought the apartment complex for. You divide it by 30. That gives you $166,000 a year that you can reduce your taxable income by. So on all that cash flow you're getting from the apartment complex that you're using to buy gold, silver, Bitcoin, maybe more real estate, stocks, you name it, you are paying zero taxes. And here's a clip from my recent interview with Robert Kiyosaki himself, where he explains his strategy that allows him to pay zero taxes. You see a book as an asset that produces cash flow. And I think that if people could see the internet, and to your point, their cell phones, as a vehicle that they themselves could produce assets that produce cash flow the same way you did with Rich Dad, Poor Dad, it would change their mindset.
Right. So I publish a book. I sell a license to 50 publishers throughout the world. Day one, I'm positive. So it may take me 2 years to write a book, let's say. It costs me $50,000, but I sell 50 licenses for $10,000 each. I'm in the money. And I have my cash flow game. Our cash flow games are blowing out. That's a 25-year-old game. And they're just blowing out the door and all this. And I'm up here in my mountain cabin and thinking about the next entrepreneurial venture. But with that cash flow from my IP, I lever up with debt to buy RP, real estate.
Yeah.
Okay, so let's say I make $1 million in IP, then I have to find a property that's worth $5 million. That means I'm going to borrow $4 million. So I've now stepped up my depreciable basis to $5 million. So I'm depreciating $5 million instead of $1 million, and I'm paying no taxes on the $1 million, and I'm getting cash flow, and with the extra income, I'm buying gold and silver.
Whoa, time out. I've got a bonus billionaire tax strategy for you. It's something they've been doing forever. Good old-fashioned money laundering. That's right. Now, I'm not suggesting you do anything illegal, but the concept is pretty much the same. You're taking money where it's kind of in this dangerous area, and you're moving it over here or through a specific entity where it's a lot more safe. So how could you apply that to your own tax strategy? Well, say you're in Chicago right now. You're planning on buying a house. You know darn well you're going to have a target on your back. They're going to be raising property taxes. Why not consider taking that money out of the state of Illinois, maybe to some place that's a little more friendly like Texas, Florida, Nevada, or take it a step further and move it outside the country to a place where you like going, you like spending time, you trust the jurisdiction, and you know that they're going to be a lot more friendly to property taxes or property owners in the next 10 years, 20 years, even 30 years. Step number 3, the next method you can use to pay less taxes, just like the billionaires, is the Elon Musk method. And I don't want to pick on Elon too much here. Pretty much all the guys, whether it's Bezos, Musk, any of the big CEOs, Jamie Dimon, they're pretty much all going to use this strategy, and you will see why in just a moment. I summarize the strategy by saying spend equity, don't sell equity. So how does that work? Well, of course, it starts with you, the taxpayer, the suckers in the equation. They pay all of their hard-earned money right to the government. The government takes that money and it gives it right to Elon Musk to build the Tesla factory. So Elon takes some of your tax dollars and some investor money. He builds himself a factory to pump out these beautiful cars. As you can see, we have a Model S on the left looking extremely fast, and this milk truck looking thing with a broken window. We'll assume that is a Tesla truck. So the Tesla factory builds and sells all of these amazing vehicles, but it costs them a lot of money to do so. So you see the expenses on their P&L are very high, but their revenues are very small. They lose a lot more money than they make. And the stock market sees this, and for whatever reason, they love it. Any company that's run by Elon Musk that can incinerate capital has to be worth billions and billions of dollars. And who knows, if he comes out with a strategy to colonize Pluto, Tesla could be worth trillions of dollars. But regardless, the stock market loves Tesla, so the share price goes Buzz Lightyear to infinity and beyond. But of course, Tesla's two favorite people in the world are the Fed and the government. They are Tesla's BFFs. Why? Because the Fed drops interest rates down to zero for almost a decade. So it allows Tesla to get all this super cheap money from investors who have to go further and further and further out the risk curve because they can't get returns from treasuries. As usual, it goes right back to the Fed. And of course, the government is grabbing and picking the pockets of all the average suckers just like you, the taxpayers, so they can give that money to Elon to start his factory, or buy a failing solar company to bail out his cousins. Either or, the net result is the same. So Elon looks at this and says, okay, this is a pretty good system, but I've got bills. It's not cheap to be Elon Musk. I've got this Echo jet that I need to fly all around the world. And the Echo jet is very green in the sense that it produces just slightly more pollution than a 1970s Peterbilt. So what on earth is Elon going to do? Well, he needs to really think. He's got to concentrate. So he takes his right hand, looks like he just got done with the Joe Rogan show, bloodshot eyes, but this is when Elon gets into the zone. He looks at his Twitter account, he tweets out something completely ridiculous that gets him in trouble with the SEC, and he says, aha! I've got a plan. I could sell some shares to get money to pay for the Echo jet, but then I'd have to pay taxes just like those sucker taxpayers. There's no way I'm going to do that. So I'll go to the bank and I'll use my billions of dollars worth of stock as collateral. The bank will give me a loan and I'll buy a bunch of million-dollar mansions. So Elon says, why don't you give me another loan against my properties and I'll use that money to go ahead and pay for my lavish lifestyle. The banks say, Elon, no problem. Here is all the money you need. You're a great credit risk. And in fact, we'll give you an even lower interest rate than we give to those suckers, the average Joe and Jane. So Elon gets all this money completely tax-free because he didn't sell his equity, he borrowed against his equity. This is how the billionaires do it. Oh, but wait, there is more. Assuming the Fed continues to print trillions of dollars worth of funny money, keep interest rates artificially low, backstop the market, who knows, they might even start buying shares of Tesla. This just increases the amount of equity Elon Musk has because the value of his shares continues to increase. Well, if he has more equity, that means he can take more and more loans from the bank. You see how this works? As long as his equity continues to increase, he can live the lifestyle of a billionaire and never pay one dime in taxes. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.